Pillar Financials has just announced a $20 million raise aimed at funding a new tool to track and trade raw materials across continents. In a market hungry for transparency, amid volatile metals, energy, and agricultural prices, this move signals both ambition and risk. Traders, hedge funds, and even traditional banks watch every funding round for indicators of what comes next in commodity technology. The timing matters because supply shocks, sanctions, and climate policy are reshaping incentives to optimize sourcing, hedging, and liquidity. If the tool delivers, users could move faster than ever before. Investors will watch proof points, adoption rates, and regulatory clarity unfold. At its core, Pillar is creating a software toolbox that aggregates pricing data, warehouse inventories, shipment routes, and risk metrics into a single trading interface. The 20 million funding rounds up capital to accelerate development, hire data engineers, and license data feeds from exchanges and logistics networks. Think of it like a weather app for commodities, predicting risk and suggesting hedges before the storm hits. Users can simulate trades, monitor correlations across oils, metals, and grains, and compare counterparties in real time. The goal is to reduce guesswork and increase timing precision in volatile markets. As data feeds improve, traders may shift from gut instinct to measurable signals. Historically, commodity trading relied on brokers, phone calls, and offline spreadsheets. Exchanges expanded data access, but the real disruption came with algorithmic trading and cloud computing in the 2010s. Firms built dashboards to monitor freight routes, inventory levels at warehouses, and shipping delays. Pillar follows a line of fintechs that turned raw information into decision tools rather than just data feeds. You can think of it as the evolution from printed maps to GPS guidance, enabling faster hedging and cross-asset comparisons. Regulators have cautioned about data quality, but incumbents still win by scale, network, and reliability. Trust and interoperability remain essential. Markets are watching Pillar not just for the money raised, but for perceived speed to market. Early pilots could push prices for data licensing, reduce latency in price discovery, and attract users who want single-pane control. In recent weeks, ETF flows into thematic commodity tech exposure have risen, even as traditional funds reassess energy bets. Traders report tighter bid-asks on algorithmic tools and more cross-market hedges. If the platform succeeds, suppliers of data feeds and logistics services may see higher capacity utilization, while small brokers face pressure to modernize or lose relevance. Global commodity liquidity could tighten further if adoption accelerates. Who benefits from Pillar's push and who bears the risk? Large energy producers, miners, and agri-traders could gain faster hedging and clearer price signals. Data providers, cloud vendors, and fintech platforms may gain scale revenues if customers adopt the tool broadly. Retail and institutional investors stand to gain new analytics, but they also face onboarding hurdles and data costs. Small banks and regional brokers might struggle to compete with integrated dashboards. Supply chain operators could see improved visibility, reducing stockouts while carriers stack cargo with smarter routing. In short, a wide cross-section feels the ripple effects. Legacy traders may resist change. Geopolitics and macroeconomics set the stage for Pillar's fundraising signal. Sanctions, tariff battles, and shipping bottlenecks tighten supply lines and raise hedging demands. Energy prices swing with political risk, while industrial demand shifts as economies recover unevenly from last year's shocks. Central banks debate inflation and liquidity, influencing funding costs for software firms and data vendors. A rising US dollar versus several currencies can mute localized commodity moves, complicating cross-border trades. Across the globe, traders are recalibrating models to survive policy surprises, weather events, and geopolitical flashpoints. That mix pushes demand for transparent risk analytics and scalable tools now globally. Smart money is testing hypotheses rather than committing at scale. Some hedge funds are quietly funding pilots, seeking early access to predictive models for spread trades and cross-commodity hedges. Banks and asset managers may partner with pillar-type platforms to offer clients turnkey analytics, paying for data reliability and uptime rather than pure software. Retail traders watch from the sidelines, yet accumulate knowledge through newsletters and small-cap data vendors. Venture capital firms are weighing follow-ons, while incumbents in logistics and risk management prepare white-label solutions to compete. In sum, cautious experiments are the trend. Liquidity remains fluid. Every new tool invites overconfidence and operational risk. If Pillar fails to deliver clean data feeds, latency gaps, or user experience that actually saves time, adoption could stall. There is also concentration risk. A few data partners and cloud providers could become single points of failure. Regulation may tighten around data privacy, pricing transparency, and antitrust concerns, complicating partnerships. The tool could create false signals if models overfit to recent volatility. Additionally, budget constraints and integration headaches might push traders back toward legacy systems. And in worst case, capital inflows could dry up as expectations crumble. Competition could intensify, leaving weaker entrants stranded. Retail investors can participate carefully by educating themselves about how analytics platforms work. Start with small allocations to thematic exposed funds or ETFs that track data and technology for commodities, rather than chasing hype on a single startup. Ask questions about data sources, latency, and transparency before committing. Use backtests and paper trades to understand risk while avoiding over-reliance on blind forecasts. Diversify across assets and avoid concentrated bets in any one metal, energy, or agricultural chain. Remember that every innovation carries execution risk. Disciplined risk management remains the key to staying in the game. Stay skeptical, track cost to value, and learn from setbacks. Looking ahead, Pillar's tool could become a standard element in diversified commodity desks, much like ERP systems became essential for manufacturers. Adoption will hinge on data quality, uptime, and interoperability with existing platforms. If successful, it may compress cycle times, expand access to risk analytics, and attract new capital into non-traditional corners of the market. Skeptics warn that hype can outpace execution, that costs creep, and that data becomes a weapon in a crowded field. The next few quarters will reveal whether the promise translates into real gains for users and investors. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.